February 13th, 2026. Silver just crashed to $76. Shanghai is paying $87. That is an $11 premium. The largest physical silver market in the world is paying 14% more than the paper price in New York. Read that again. Physical buyers in Asia are paying $11 more per ounce than futures traders in America. That is not a spread. That is a divorce. And what I'm about to show you is not a correction. This is the paper market dying in real time. While Western traders were selling silver from $83 to $76, a 9% collapse in hours, Shanghai buyers did not blink. They kept buying. They kept bidding. They kept paying premiums that should not exist because they know something Wall Street does not want you to understand. The metal is gone, the vaults are empty, and the paper contracts are about to become worthless. By the end of this, you will see why the crash was not capitulation, it was desperation. Let me show you what happened in the past 48 hours. Wednesday morning, silver was trading at $83. The chart looked stable. Volume was normal. Then without warning, without news, without a catalyst, the floor disappeared. $83 became $80. $80 became $70. $77 became $76. 8% evaporated before most traders could process what was happening. Stop losses triggered in cascades. Margin calls exploded. Retail accounts liquidated automatically. But here's what nobody is telling you. While paper silver crashed, Shanghai physical held firm. $89 spot. $89 futures. The premium did not shrink. It grew from $4 before the crash to $11 after. That tells you everything. When paper collapses and physical premiums explode, you're not watching a normal market. You're watching the pricing mechanism break. Let me explain what a premium means. In a normal market, arbitrage keeps prices aligned. If silver is cheaper in New York than Shanghai, traders buy New York and sell Shanghai. They pocket the difference. The spread closes instantly. But right now, the spread is not closing. It is widening to $11. Why? Because the traders who would normally execute that arbitrage looked at the risk and walked away. They know if they buy paper silver in New York, they might never get the physical metal to ship to Shanghai. They know the contract might be settled in cash instead of bars. So they are letting the $11 bill sit on the sidewalk. Because picking it up requires trusting a system they no longer trust. Now, let me show you why this happened now. Why did silver crash on Wednesday instead of Tuesday or Thursday or next week? The answer is calendar warfare. Sunday, February 15th. The Shanghai Metals Exchange closes for Chinese New Year. It does not reopen until February 23rd. 8 days. For 8 full days, the largest physical buyer of silver on planet Earth goes completely dark. No bids, no orders, no absorption of selling pressure. The market loses its biggest source of price support exactly when Western paper markets are most fragile. And the banks know this. They have known this for weeks, and they used it. Look at the pattern. Every single year during Chinese New Year, Western paper prices get hammered. Every year, the same playbook. Wait until Shanghai goes offline. Wait until the physical bid disappears. Then unleash selling pressure that would normally be absorbed by Eastern buyers. Drive the price down 10%, 15%, 20%. Shake out weak hands. Trigger stop losses. Force liquidations. Then when Shanghai reopens and the physical bid returns, cover shorts at the bottom and ride the snap back higher. This is not conspiracy. This is observable market behavior repeated annually with clockwork precision. But this year, the attack is more aggressive. This year, the drop is faster. This year, the timing is more precise. Why? Because this year, the underlying tension is greater. This year, the mismatch between paper claims and physical metal has reached a level that threatens the entire structure. And the banks are not manipulating for profit anymore. They are manipulating for survival. Let me show you the data Wall Street does not want you to see. March open interest on COMEX sits at approximately 86,000 contracts. Each contract represents 5,000 ounces. That is 429 million ounces of paper claims. Now look at registered inventory. Registered inventory is the metal actually available for delivery. Right now, COMEX registered sits at 103 million ounces. Do the math. 429 million claims divided by 103 million ounces available. That is a ratio of more than 4 to 1. For every ounce of real silver sitting in the vault, there are 4.1 paper contracts demanding delivery. In a normal month, only a small fraction of contract holders stand for delivery. Most roll forward or settle in cash. The system works because everyone pretends the metal is there. But February was not a normal month. In February, delivery intentions exceeded 100% of open interest. More people demanded physical metal than the total number of contracts outstanding. That should be mathematically impossible, but it happened. And COMEX did not default. They scrambled, they begged, they found metal from emergency reserves, they survived. Barely. But March is worse. March has higher open interest, March has barely adequate registered inventory. March is the month when the math finally breaks, and the banks know it. So they are doing the only thing they can do. They are trying to crash the price so violently that contract holders panic and sell instead of standing for delivery. They are trying to create a stampede away from physical settlement before the vault runs dry. This explains the Wednesday massacre. This explains why silver had to drop 9% in hours, because the alternative is a default. The alternative is COMEX admitting they cannot deliver on their contracts. And if that happens, if the futures market loses credibility, the entire paper pricing system collapses. The price of silver stops being determined in New York and starts being determined in Shanghai. And at Shanghai prices with an $11 premium, the Western banks holding short positions face losses that would vaporize their capital bases overnight. But there is another mechanism at play that most people miss. We need to talk about SLV. We need to talk about the silver ETF that holds 522 million ounces, and what happens when it trades at a discount to net asset value. Right now, SLV is trading below its NAV. The share price is lower than the value of the metal it supposedly holds. In theory, this should never happen. In theory, if the ETF is cheap, arbitrageurs buy the shares, redeem them for physical silver, and sell the metal at spot price. The discount closes instantly. But right now, the discount is not closing. It is sitting there. And the reason is that authorized participants are using it as a weapon. Here is the mechanic. If you are a bank with a massive short position in silver futures, and you need physical metal to deliver against those contracts, you have a problem. You cannot just go into the market and buy 400 million ounces. That would drive the price vertical. So instead, you go to SLV, you buy shares at a discount, you redeem them for physical silver, you deliver that silver against your short contracts, and you do it quietly without triggering a price spike because the ETF redemption does not show up on the futures market until after the fact. By the time anyone realizes what happened, the metal is gone and your short position is covered. This is why SLV inventory has been bleeding for months. This is why the discount persists. The ETF is being drained to backstop a paper market that is running out of metal. And every ounce that leaves SLV is one less ounce available for retail investors who think they own silver, but actually own shares in a shrinking pile of bars controlled by banks. So we have a COMEX that is underwater on deliveries. We have an SLV that is being drained to cover short positions. We have Shanghai closed for 8 days, removing the physical bid. And we have a price crash timed perfectly to maximize panic. Before March 1st, notice day. This is not a market. This is a battlefield. And the Wednesday attack was the opening salvo of a campaign designed to prevent a short squeeze that could bankrupt the Western banking system. But here is what they did not count on. Here is the variable they cannot control. The physical buyers are not panicking. In fact, they are doing the opposite. They are buying more. Look at the premium. $11. That premium existed before the crash. It exists after the crash. It is not shrinking. It is growing. That tells you that the people who actually need silver, the manufacturers, the industrial users, the strategic reserves, they are not scared by paper price action. They are ignoring it. They are looking at supply and demand. And supply and demand says there is a deficit, a big one. For the 6th consecutive year, global silver demand exceeds supply. The deficit continues to drain above ground stockpiles. India alone is importing 25% of total global mine production. Just one country, one buyer, absorbing a quarter of everything dug out of the ground. And India is not selling it back. India is hoarding it. India is moving it into temples, into jewelry, into private vaults, where it disappears from the tradable float forever. China is doing the same. China's silver imports hit record levels last year, and those imports are not being re-exported. They are being stockpiled. They are being converted into industrial products that consume the metal permanently. Solar panels, electronics, batteries. Every ounce that goes into a solar panel is an ounce that never comes back to the market. It is locked in a physical form that cannot be recycled economically. The metal is being destroyed in real time, and the rate of destruction is accelerating. Meanwhile, mine supply is flat. The big discoveries have already been made. The easy ore has already been extracted. What remains is lower grade, harder to process, more expensive to refine. Miners are not expanding production because at current prices, the margins do not justify the capital expenditure. So supply is capped, demand is rising, and the gap between the two is being filled by above-ground inventory. The stockpiles, the reserves, the metal sitting in vaults waiting for the day when the price finally reflects scarcity. But those stockpiles are finite, and they are shrinking. COMEX registered is at 103 million. SLV inventory is at 522 million and falling. Every major vault in the Western world is reporting drawdowns. The metal is leaving. It is flowing east. It is moving from weak hands to strong hands, from paper speculators to physical hoarders. And once it crosses that bridge, it does not come back. This is why the banks are desperate. This is why they had to crash the price. Because if the price keeps rising, if silver hits $100 or $120 or $150, the floodgates open. Every pension fund, every sovereign wealth fund, every institutional investor that has been sitting on the sidelines waiting for confirmation suddenly rushes in. The demand curve goes vertical, and there is not enough metal to satisfy it. The system seizes. COMEX defaults. The ETFs suspend redemptions. And the price discovers a new equilibrium in a world where paper is no longer accepted as a substitute for physical. We are staring at a binary outcome. Either the banks succeed in crushing sentiment, scaring away buyers, and forcing contract holders to settle in cash, or they fail. And the short squeeze triggers a repricing event that redefines the entire precious metals complex. There is no middle ground. There is no slow, orderly transition. The math is too broken. The leverage is too extreme. This resolves violently one way or the other, and the timeline is short. March 1st, notice day is February 27th, 15 days from today. In 15 days, every contract holder has to declare whether they are standing for delivery or rolling forward. If even 25% of March open interest demands physical, we are looking at more than 100 million ounces demanded against a registered inventory of 103 million. COMEX would be stretched to the absolute limit. They would have to source metal from every available channel. They would have to drain SLV even further. They would have to beg mining companies for forward delivery. And if they cannot, the default becomes public. And when the default becomes public, trust evaporates. The futures market loses its function. And the price detaches completely from paper and starts trading purely on physical availability. But there is one more factor we have not discussed, one more variable that could accelerate this entire sequence. Tomorrow, February 14th, the consumer price index data drops, inflation data. And the timing is suspicious. Think about it. Silver crashes the day before a major economic release. That is not random. That is positioning. Someone knows what the CPI number is going to say. Someone got early access, and they are front running it. If CPI comes in hot, if inflation is worse than expected, metals rally hard. Because inflation means currency debasement. It means the dollar loses purchasing power. It means real assets like silver and gold become more attractive. So if you know CPI is going to be hot, you want to buy metals before the data drops. But you cannot buy at current prices. The market is too tight. So you crash the price first. You trigger a liquidation, you shake out the weak hands, you accumulate at $76. And then when the data drops and the market realizes inflation is still raging, you ride the snapback to $90 or $100 or higher. That is the play. That is why Wednesday happened. Not because of risk off, not because of technical selling, because someone with access to embargoed data positioned ahead of a move they knew was coming. And when CPI prints tomorrow, we will know if the theory is correct. If metals explode higher, the front running is confirmed. If metals fall further, the theory is wrong and we are in a genuine deflationary scare. But one way or the other, the price action tomorrow tells us what the insiders already know today. So where does this leave you? What do you do with this information? Do you panic? Do you sell? Do you assume the crash is the start of a collapse? No, you do the opposite. You recognize this for what it is, a shakeout, a manufactured dip designed to scare you out of a position before the real move begins. The fundamentals have not changed. The deficit continues for the 6th consecutive year. India is still importing 25% of global supply. COMEX registered is at 103 million with 429 million in claims. Shanghai is still paying an $11 premium. The metal is still flowing east. The stockpiles are still shrinking. None of that changed in hours. What changed is sentiment. What changed is that weak hands got shaken. What changed is that the banks bought themselves 8 more days to try and survive March. But they have not solved the problem. They have only delayed it. And every day they delay, the pressure builds. Every ounce that flows east is one less ounce available in the west. Every contract that stands for delivery is one more claim against a vault that is already stretched thin. The math is tightening. The noose is closing. And the Wednesday crash, as brutal as it was, as terrifying as it felt, was not the end. It was the prelude. We are now in the quiet period. Shanghai is closed. The physical bid is offline. The banks have 8 days to push the price as low as they can. They will use every tool. They will sell paper contracts with no metal backing. They will drain SLV. They will trigger stop losses. They will create the illusion of a market in free fall. And some people will believe it. Some people will sell at the bottom. They will capitulate at $76 or $70 or $65, and they will watch in horror as the price screams back to $90 when Shanghai reopens. But the ones who understand the game, the ones who see the mechanics, they are not selling. They are waiting. They are watching the calendar. They are marking February 27th on their wall. Because that is the day when the math becomes unavoidable. That is the day when COMEX has to reconcile the ledger. And if delivery demands surge, if contract holders refuse to roll forward, if they insist on physical settlement, the system faces its greatest test. The registered inventory of 103 million ounces against potential delivery demands exceeding 100 million creates a margin of error so thin that any disruption, any delay, any logistical failure becomes catastrophic. This is not financial advice. This is battlefield reconnaissance. I'm not telling you what to do. I'm showing you the mechanics. I am showing you the weapons. I am showing you the tactics. And I am showing you that the Wednesday attack, as devastating as it appeared, was not a victory for the banks. It was an act of desperation. They are not crashing the price because they are strong. They are crashing the price because they are terrified. They are terrified that March is the month when the leverage finally breaks them. And they are doing everything they can to prevent it. But they cannot change the math. They cannot print silver. They cannot create supply where none exists. They can manipulate the paper price. They can trigger liquidations. They can create fear. But they cannot alter the fact that demand exceeds supply year after year. They cannot change the fact that COMEX registered is at 103 million ounces, facing 429 million ounces in claims. They cannot change the fact that Shanghai is paying an $11 premium. The fundamentals are immovable, and the fundamentals always win. The question is not if, the question is when. And based on the calendar, based on the delivery schedule, based on the timeline we are looking at, when is measured in days, not months. So pay attention tomorrow. Watch CPI, watch how metals react, watch whether the theory of front running is confirmed or disproven, and then watch the next 8 days. Watch how far the banks can push the price while Shanghai is dark. Watch whether $76 holds or whether we retest $70. Watch the premium. Watch whether it shrinks or expands, because the premium is the truth. The premium is the market telling you what physical silver is actually worth when you strip away the paper illusions. And if that premium keeps growing, if it hits $12 or $50 or $20, you are watching the pricing mechanism fracture in real time. You are watching the divorce between paper and physical become final. The crash was not an accident. The timing was not random. The mechanics were deliberate. Verify everything. Check the COMEX data. Check the SLV inventory. Check the Shanghai premium. Do not trust me. Trust the numbers. And when the numbers confirm what I am telling you, then you will understand that Wednesday was not the end of the silver story. It was the beginning of the final chapter.